Jyoti, to you, lots of facets to autos. I actually wanted to start off with the commercial vehicles and whether the markets is right in being disenchanted with what a Tata Motors or an Ashok Leyland have done. Maybe let's start off with that and then talk about the two-wheelers. What do you feel? Tata Motors was never in the picture, but Ashok Leyland had a very strong last 18 odd months. But the last 4 or 5 or 6 odd months have been bad for Ashok Leyland and have been terrible for Tata Motors.
Yeah, so the CV cycle was doing well, and the general consensus, my expectation also was till 19 it would do well, because then you have the BIS 6 norms coming, so there'll be a lot of pre-buying before that. What has really spooked the story in the near term has been the fact that overloading has been allowed. So just allowing that overloading means that suddenly the sales may not be as high as it was anticipated. We could have a few weak months because suddenly there's no real demand for trucks because the existing trucks can load much more than what can happen. But otherwise, it's something like, at some point, as the market normalizes to this, I think we'll have a strong spell ahead of us in terms of the truck segment.
Jyoti, where are you seeing value in terms of your fund? Which are the sectors that you started to nibble into, and which are the sectors that are off limits currently for you?
So, our big bet has been on capital goods. So it's something which is not consensus. We keep looking for stuff where, the sector is totally out of favor, where ownership is very low. And we like capital goods because my views over the next few years, we'll have the economy turning around. And, you've seen volume growth come in to all these people. There's been no capacity addition in the last 10 years. So because of that, utilization levels are picking up, and as utilization levels pick up, you're seeing huge margin improvement coming through because of operating leverage. So that's one segment which we are focused on quite a bit, and where we think, there's money to be made for investors.
Okay, some stocks that wanted to focus. Nestle at 10,600 at lifetime high. Excel Crop Care at lifetime high, that's moved to 4,500. And Neeraj, one stock which has stunned everyone is Ibulls Ventures after a brief gap. It's at 600. A couple of, I think not even 2 years ago, or probably early last year, was trading at 20 rupees. It's 600 now. No doubt it wants to follow the Bajaj Finance. It's like a mini Bajaj Finance. They are into that. They're developing their the business model is like that. I'm not comparing directly, but what they want to do is get into commercial lending for white goods, and what exactly Bajaj Finance does, and no doubt the price move has been stunning on that one.
Oh, very, very interesting. Jyoti, these NBFCs, and we attended a couple of meets wherein people came out and gave out their top recommendations for the next 2-3 years. Invariably, even post the run-up, at least 30% of the ideas have some flavor of the financialization and the financial savings theme, and therefore go out into NBFCs in whatever shape or form, be it the AMCs, which is now becoming a space, be it insurance, or be it pure play lenders. Do you find merit in that argument? And are you a large owner of the non-banking financial services side?
So, the reason, partly if we think about it, the index also is more than a third is the financial space. And, the new listings are just coming in. So as, AMCs and insurance gets put in the index, the risk is it probably goes beyond 40%. So any portfolio which is constructed would need to have quite a bit of flavor of the financials, whether it's the banks or the NBFCs or, insurance, asset management, because that's the way the index is composed. We are in the space, but given where the index weight is, I would not say we are hugely overweight that space, because it's a very big index weight which is there in the financial space.
Interesting. So that is one. The other aspect, and something that I want to get back to, is because you said that you are more anti-consensus. Are you anti-consensus right now on the two-wheeler space? Bajaj's commentary has led to almost all of these stocks veering off the cliff, literally. Is there merit in looking at any one of the 3 large listed two-wheeler companies? I'm ruling Eicher out here because that's kind of a different kettle of fish altogether, but the other 3 which have more homogeneous nature of business. Is there merit in looking at this space?
So, there are two ways you can look at the space, right? One is by the two-wheeler manufacturers themselves, and the other is by the ancillary companies. So, if we look at the manufacturers themselves, the indication is clear that there's going to be effectively a bit of margin squeeze, because, there's competition means margin squeeze. But at the same time, you probably will get volume growth. So, if you want to play that volume growth, but I don't want to take the risk of a margin squeeze, then maybe the ancillaries are the better way to play it, because you get the whole benefit of volume growth coming through there, and they may not feel exactly the same margin squeeze which the main manufacturer may feel. So that is the way we are really playing the two-wheeler space, rather than playing it with the manufacturers themselves.
Interesting way to do that as well, and well, not completely out of whack. A bunch of players would probably do that. My final question, Jyoti, at least my final question, Darshan, I'm sure probably would have a couple more, but my final question is centered around this whole consumer durable space. Now there are some clear factions emerging. The cooling solution companies, weighed down by the irrational or erratic weather, let me not call it irrational, have seen performance which has dwindled a bit. On the other hand, the pure play consumer durables seem to be doing okay. However, when the GST cuts happen is when companies like Vijay Sales, which are selling these durables, mentioned that after a very lackluster the first quarter, we might finally see some semblance of sanity out here. And buoyed by that, there's some bit of uptick that we've seen in some of these names as well. Proxy of what the consumer spend in India could do, are you looking at this pocket at all?
Yes, we like this space because the penetration is low, incomes are rising, and so these are things where just if you think of a secular 3-year, 5-year view, the growth will be very high, and that the demand will pick up. For us, a lot of these aberrations where 1 month, 2 months, sales are down, those are the opportunities which we find that, okay, now, we're getting decent valuations to buy some of these stocks. So we are always happy with stuff like this as long as our overall 2-year, 3-year thesis is not getting disrupted.
Jyoti, any view on PSU banks? Most of them have been beaten out of shape. We've seen a little bit of rebound that's come in. What's the strategy in terms of financials? Would you go in for the PSU banks which are low on valuations, or would you stick to the high value, quality stocks of the private sector bank, retail focused?
Okay, so not necessarily PSU banks, but we are buying the corporate banks. So ultimately it is you buy either the retail banks which are very high valuation, or the corporate banks which are cheaper. They need not necessarily be the PSUs, because I think over the next 2 years we'll see like a big change in the NPL profile. A lot of the provisioning is behind us. The bankruptcy code has been slower than what I thought it would be, but it still seems to be working, and so I think we'll have much better news for the corporate banks going forward, and that's where probably you can make a disproportionate return.
Okay. Jyoti, it's been a pleasure today. Thank you so much for taking the time out, but it was good having you after a really long time.
Thank you.
Look forward to having you more often on this forum.